Welcome to KBRA Podcasts, where we cover topical research discussions, industry commentary, and more. Stay tuned for insight from our knowledgeable team members.
Hello, welcome European listeners and market participants, and welcome to KBRA's latest European Credit Podcast, Conversations in European Credit. I am Gordon Kerr, Head of European Research at KBRA, and today I'm joined by my colleagues from across our ratings teams. We've broken the discussion into two sections. This one, our first of two Outlook podcasts, will focus on the consumer-oriented collateral within European securitizations. We will be covering the content of our 2023 Outlook, which was published at the beginning of December. In the report, we discuss our views on the outlook for European securitization, where the extreme inflation of 2022 will continue to impact collateral performance and issuance volumes over the year ahead. In particular, as central banks combat with inflation and with interest rate hikes, a number of securitization sectors will contend with more difficult financing conditions. In addition, the deceleration in growth across Europe, coupled with 2023's widely expected recessionary conditions, could also weigh on performance. Sensitivity to energy prices and energy transition objectives will be key to performance as we head into the year ahead. On the positive side, the market approaches these challenges from a position of strength with high, albeit decreasing savings levels, low unemployment, and steadily positive growth in house prices and asset valuations that have happened over the last 7 years. First, let me bring in my colleague from our sovereign ratings team, Ken Egan. Ken, let's start with a bit more detail on the backdrop facing the European consumer over the year ahead. Where do we see the inflation picture and the cost of living impacting upon borrowers across Europe?
Yeah, thanks, Gord. Inflation was a key theme in our outlook in December last year, but no one expected the severe repricing of energy within Europe. This has significantly influenced inflation levels across the continent, which we expect to continue in the year ahead. Even with a moderation of energy prices, the cost of energy is poised to remain well above historical norms, while input costs will likely be pushed through to the consumer. Although the unwinding of supply chains might be disinflationary, energy prices, which are sustained at elevated levels, will keep inflation above target. For consumers, inflation erodes savings, weakens purchasing power, while increasing costs will pressure available funds and increase the risk of delinquencies. Inflation across Europe has mainly been focused on rising energy and food prices, and I would highlight that there is a wide dispersion of inflation across Europe with varying resiliency among sovereigns. In terms of specific drivers, energy has gone from a period of decreasing prices starting in August 2019, helping to keep inflation low, to a period of positive price inflation starting in March 2021. Energy price rises then began to accelerate in 2021, reaching above a 3% annual rate of increase after Russia invaded Ukraine in February of this year. This contributed substantially to the increased levels of inflation in the euro area. Out of the total annual inflation of 10.6% in October 2022, 4.4% is from energy, 2.7% is food, 1.8% is from services, and 1.6% is from non-energy industrial goods. As the Russia-Ukraine war continues, this situation is unlikely to reverse in the near term. Energy prices should come down from their extreme highs, but will probably remain elevated as Europe hopes for a milder winter. Energy prices have begun to feed into other areas of inflation, with industrial goods pricing now contributing to inflation rates as they look to pass on the energy cost input. Historically, industrial goods excluding energy companies have contributed very little to inflation rates.
Thank you very much, Ken. With central banks now obviously looking to fight inflation by raising rates, what does this mean for borrowers across Europe?
Yeah, Europe's main source of inflation to date has been from the supply side with dramatically increased energy costs, while central banks are targeting the demand side in order to stabilize inflation. So there is a bit of a mismatch for consumers. Interest rate hikes impact consumers with elevated borrowing costs. While many have existing deals with low fixed rates, as these roll off, borrowers will face more expensive refinancing costs and in some cases substantially higher rates. Moreover, as rates rise, property valuations decrease. This could likely impact most residential property markets, for example. The significant rate hikes by central banks worldwide will cool global growth. One area where increasing interest rates will have the most significant effect on households is in the cost of mortgage borrowing. Rates are expected to continue to rise in the year ahead. This will have an impact on borrowers in terms of new lending, refinancing, and in some cases, outstanding borrowing. Forward rates for 1 month borrowing in 1 year's time show that rates are expected to remain elevated in 2023. Forward rates versus December 2023 1 month borrowing indicate levels of 2.6% in the euro area and 4.4% in the UK.
Thank you very much, Ken. So with this environment, what does this mean for European securitization markets? Well, there are several elements that will influence European securitization markets from the perspective of issuance volumes in 2023, a funding mismatch, collateral performance, regulatory influences, and quantitative tightening. As the market adjusts to the rising rate environment, underlying collateral that has been originated previously at lower rates may be below the current cost of funds, thereby making securitization of the lower rate collateral challenging. Collateral performance is likely to show signs of concern, which will increase investor scrutiny and as a result place greater differentiation between sectors and transactions. On top of this, Basel III regulatory changes will affect the dynamics yet again for the viability of certain sectors. Further, as the European Central Bank increases the cost of funding for its refinancing operations and as maturities approach for the TLTRO program, there is potential for this collateral to be used in publicly sold securitization transaction. KBRA expects that the coming year will see a dynamic market for European securitizations with an increase in public securitizations sold to investors and a decrease in total securitization. This will depend on market conditions, of course, as investor demand will be key to ensuring the market can absorb the potential increased supply. Newly circulated transaction volumes are estimated to increase to around 130 billion, up from the 73 billion in the first 9 months of 2022 and the 115 billion in 2021. Overall, we expect total securitizations to be down with the potential for minimal retained issuance. To transition now into the performance of the European consumer in collateral, let's bring in my colleague, Killian Walsh from the ABS ratings team. Killian, what do you see as the impact that this environment that Ken outlined earlier will have on European consumers?
Thanks, Gordon. I suppose piggybacking off what Ken said, the consumer ABS market has seen challenging conditions in 2022 as funding costs have risen, credit spreads are widening, and credit fundamentals have drifted negatively. Performance for the European consumer is expected to remain challenged over the coming period. As Ken and yourself have pointed out, inflationary pressures and rising interest rates will weigh on consumer income and balance sheets. Hence, consumer ABS fundamentals are expected to generally weaken over the next year as real consumption prices continue to outpace real wage growth. It is likely that the potential for rising unemployment levels, as has always been the case in looking at consumer performance, will continue to be the primary driver of credit performance in 2023. I suppose a couple of credit positives mitigating these trends coming into the year is, as you pointed out, the current low unemployment levels, and that broadly across Europe, household balance sheets are generally in a much better place today relative to the global financial crisis, as households have significantly delevered over the previous decades and years of low interest rates have pushed household debt service payments to historically low levels. The unsecured consumer market, inclusive of credit cards, has experienced the first sign of credit deterioration during 2022. These signs of slight rises in delinquency and loss rates seem attributable to the wind down of pandemic-related stimulus programs and high inflation. Potential financial stress will almost certainly cause lower creditworthy borrowers to take out additional loans and prioritize payments to secure debt. Consequently, we expect to see consumer loan and credit card performance migrating to pre-pandemic levels and potentially deteriorating moderately from these positions as the rising cost of living and potentially higher unemployment levels take a toll on performance.
Thanks, Killian. One of the main and steady issuers of securitizations are the auto manufacturers and lenders. What do you foresee for the European auto market in 2023?
I suppose we come from a point in 2022 where the sharp rise in used vehicle prices has boosted credit performance, proving recovery and loss rates. Inflated vehicle prices translate into higher liquidation proceeds on defaulted receivables as repossessed vehicles sold at higher prices relative to the outstanding loan amount. Increased vehicle values also incentivize borrowers to make timely payments or reduce the churn in delinquency status, as higher replacement costs were a strong incentive not to fall into default and deal with the prospect of repossession. Conversely, slowing demand and the commencement of falling vehicle prices late in the second half of 2022 have put some pressure, not witnessed in a while, on the securitized auto loan credit performance. However, auto ABS performance is set to be buoyed, at least in the first half of the year, by the continued strength in the used car market, which will likely remain inflated due to the continuing supply-side shortages, as the production of new vehicles has yet to catch up with demand.
Thank you very much, Killian. After the consumer, we have the challenge of households with mortgage rates increasing rapidly. Turning to my colleague, Kali, how do you see the environment discussed by Ken impacting upon mortgage borrowers?
Thank you, Gordon. In the UK, where there is a greater data availability on repossessions, we have seen the residential borrower and landlord repossessions have been increasing from their drop-off at the pandemic's onset as lenders undertook forbearance measures rather than repossessions. Since then, court repossessions in the UK have increased to approach pre-pandemic levels. There were 59,626 repossessions in Q3 2022, of which only 9,352 were for owner-occupied mortgage repossessions. Mortgage and landlord repossessions remain below pre-pandemic levels, but are on an upward trajectory, which is not expected to reverse in the year ahead. However, it would require a substantial increase to reach Q1 2014 levels. So KBRA observes that there is a correlation defaults have with increase in unemployment. And having seen the experience post global financial crisis, servicers and banks in the UK, Ireland, and some of the other European jurisdictions prioritize rehabilitation of a delinquent loan by offering temporary forbearance measures over foreclosure or repossessions. Now, because of this approach, defaults generally lag 12 to 18 months since the first time a loan gets into delinquent status. So there is a high probability that performance in residential mortgages will deteriorate in 2023 as inflation and interest rate rises start to weigh on mortgage borrowers. But then, despite expectations for 2022 of ongoing increased delinquencies, they have not significantly materialized in UK mortgage pools. And this could be driven by the fact that UK consumers, for example, also typical to consumers in European jurisdictions, have access to the savings during the pandemic lockdown period. The other aspect which is resulting in stressed finances for households is around the mortgage interest rates. Mortgage interest rates in Europe have been rising steadily since rates began to increase in 2022. The average mortgage rate across the euro area have risen from a low of 1.3% in December 2021 to nearly double at an average rate of 2.5% in September 2022. These are expected to increase further as the European Central Bank has stated that base rates should rise further.
Thank you very much, Kali. Now, what about the potential impact this environment may have on house prices?
The current environment of diminished disposable household income will mean lower loan amount eligibility for house purchase, which in turn will mean the house price rise, which has been observed since the beginning of the pandemic, will taper off. Europe house prices have risen at a more rapid pace since the pandemic. as COVID influenced people to change their lifestyle and move to another home or out of rental accommodation, demand for housing increased, resulting in elevated house prices across the continent, with few exceptions. From 2015 to Q1 2020, annual house price growth across various countries ranged between 1 and 8%, except for Portugal, which had an average growth rate of about 11%, and Italy, which had a marginal decline of 0.1%. So after Q1 2020, annual house price growth has outpaced the prior 5 years in nearly every country. Again, the exceptions are Portugal with about 11% increase in house prices between Q1 2015 to Q1 2020, and a similar level of increase in house prices from Q1 2020 to Q2 2022. Similarly, in Spain, we observe 6.3% increase in house prices between 2015 and Q1 2020, and since then, an increase of about 5.2%. The other exception is Cyprus, where house price growth has turned negative since the pandemic, falling 1% since Q1 2020. These high growth rates are expected to reverse as interest rates and inflation begin to pressure affordability, as I mentioned before. However, there remains a strong cushion of value between the current levels and those of only 2 years ago. While recent buyers will be at greater risk of falling into negative equity, depending upon the country, they are also likely to have locked in low interest rates and will face refinancing challenges within several years, giving them time to adjust their finances.
Bringing this all together, Kali, what impact does all of this have on European RMBS transactions?
While the current level of delinquencies are low, KBRA expects delinquencies to increase. Any increase in defaults will be linked to increase in unemployment. RMBS transactions generally have liquidity support features in their structures to mitigate the liquidity stress on account of increase in delinquencies. Now, such liquidity stress may also be mitigated by the temporary forbearance measures, which may ensure a cash flowing status for a delinquent loan, though at relatively low levels. Irish RPL portfolios, UK non-confirming, self-employed borrowers in general, as well as borrowers in the vulnerable category, will be the most sensitive to the current stressed environment of diminished household income.
Thank you very much, Kali, and thank you, Ken and Killian, for your comments. As you can see, the current market situation is a challenging one. One certainty for the year ahead is that it will not be easy, but everyone has had plenty of warning. The pandemic recovery, low interest rates, quantitative easing, and the Russia-Ukraine conflict have all contributed to surging inflation. Central banks are pulling back on their previously accommodative policies and increasing rates. This is expected to amplify the cost of living for consumers and the profit for margins of businesses. This will inevitably affect the performance of transactions in the European securitization markets. The scale of this will be determined by the length and severity of the economic contraction and the degree of increased unemployment. However, borrowers are approaching the oncoming challenges from a positive position with high savings rates and recently positive wage growth. European securitization markets face equally daunting headwinds, with these challenging times for collateral poised to restrict issuance in some sectors of the market. However, issuers will see a demand for funding and capital in the years ahead and may need to rely on the securitization market to help support their financing needs. Investor demand is likely to support an increased level of placement in higher quality collateral. We at KBRA actively monitor the market movements and performance. Make sure you are registered on our website, kbra.com, have subscribed to our podcast, and of course, are engaged with our experienced analysts that you have heard here today. Thank you very much for listening. We look forward to bringing you more conversations in European credit. Best of luck to you in the year ahead as the market faces a number of challenges and opportunities.
This concludes our episode. Please continue the conversation on LinkedIn and Twitter at Kroll Bond Rating. We'd also like to remind you that all of our ratings and research reports are available at kbra.com. Lastly, please share any feedback or ideas for future podcast episodes by emailing us at media@kbra.com. We hope to see you next time.